You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And with that tune, that rockin' tune, it is time once again for the Option Block, your bi-weekly show with options wit, options wisdom, options this, options that, with fantastic hosts, guest hosts, and we'll just call them co-hosts as well. I'm Andrew Giovinazzi from OptionPit.com, substituting for Mark Longo here at the Option Insider Radio Conglomerate. I am beaming in live from Maine. We're doing this through Chicago with our excellent producer. And with me is none other than, I believe, Uncle Mike Tosaw. Uncle Mike Tosaw, welcome to the show.
Great to be here, as always. And what's ironic, I have one brother and he has no kids, so the only uncling that I'm doing is through all my wife's family.
So, and also on this show.
And this show. So,
and you're uncling this show.
But if my wife ever leaves me, then I'm no longer an uncle. So I guess that's all the more motivation to stay married.
I guess so. Let's hope that doesn't happen for you. We'll go with status quo. We'll go with the status quo.
Let's hope so.
So because if you lost the uncle moniker, I really don't know what we would actually be able to do on the show.
I don't know.
To be honest. All right. Okay. With myself and here's another thing. I know this is really surprising to all the listeners, but once again, Mark is in a sunny climate on a work assignment at a conference of sorts that usually has golf, cocktails, and a lot of green grass and sun. But we're going to ignore that. We'll just fill in for him here and not really worry or care about that. I
think we should say mean things about him behind his back. I really think, yeah. You know what I bet he's doing? I bet he's slinging himself. I bet he's down there trading a bunch of stupids. That's what I think he's doing.
He's in front of the screen and he's slinging some stupids somewhere.
I bet that's what he's doing on illiquid options at that. On options that have underlyings that cost less than $5, he's doing stupids. Yeah, that'll fix him.
Maybe we can get Gene to tweet that out.
Yes.
How many stupid things is Mark trading in Florida?
On illiquid options, on stocks that are less than $5, Mark is buying call stupids.
I actually think that's possible. You never know exactly. It depends on how many cocktails he's having down there. We don't know.
Of course.
All right. Well, now that we've besmirched the owner of the Option Insider Radio Conglomerate, we will move on to one of my favorite segments, and Mike's as well. We will move on to the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
Welcome, everybody, to the Trading Block. This is where we discuss, what's trading? And I think there's a couple of interesting things today. I could do my vol spin. One is VIX was down a little bit today with SPX down fractionally. The Dow is actually up. So this is a day of what I would call vol fatigue, meaning, we've had what I would say is a pretty volatile 6 weeks in the market overall. We've had higher volatility. It's been a while since we had that kind of volatility sustained for a while. And today, I think the only thing that actually moved vol was the fact that Mueller was investigating the Trump organization. Who knows what it is, but I think that gave VIX a little bit of a kick because it was definitely sick for a while. But looks like we're closing as we record this now. It's a little bit after the close. I'm looking at most of the vol products in VIX. It's kind of near its lows, not exactly on its lows, but certainly even with the market down a little bit, that was not enough to give VIX a lift. It's hard for VIX to lift when it's trading, when it opened over 17 this morning. And we had a massive move of less than 1 point. So that is a very underwhelming move for volatility. And I'm just wondering if it portends lower vol in the future. It would be nice for me if it did, because I do have a little bit of short vol, but not a ton. But we do have sort of the situation where sort of, things are kind of slowly, let's just call them sinking from a higher activity, a higher zone, I would call it, to just a lower zone. And there's usually some interesting opportunities abound there. If you're an iron condor trader, I think this is a better time to trade them. Mostly, we kind of have that range set with the S&P 500 is sort of, 2650, 2825, something like that. So that is a more appealing trade. You still have some fairly juicy premiums. So those are more manageable trades at this level. I don't normally like iron condors, but this is probably a time where they look halfway decent because you have a chance to score relatively quickly if they kill the vol a little more. So that is a trade potential, relatively cheap hedging with VIX call spreads if you wanted to. But that is a trade setup that looks, I would say, it's something that you could look at right now. Now, if you were more of a fundamental going long type of guy, I actually have, or girl, I actually have the person who could speak to that. And his name is, Mike Tosaw of RCM Capital. It just so happens you're here.
It just so happens I'm here. Yeah. We've had a couple down days in the market thus far this week, and today seemed relatively flat. If not only vol fatigue, I think it just kind of market fatigue too. We really didn't have a lot of movement in any of the sectors for the most part. I mean, the Dow was up on the day, but in the overall scheme of things on the real market, so to speak, on the macro market with the S&P, there's really nothing sticking out from a sector standpoint. I mean, consumer staples were down a little bit, but on the flip side, you have the industrials kind of balancing them out, coming up a little bit. Energy was down a little bit, but nothing of any major significance for the market in general. During the day today, we did see a few things. Like what you were saying, we had a little bit of a downturn when it looked like they were going to investigate the Trump organization, but then it turned out to where it looks like the Trump organization is saying that this is not new news. We've been cooperating since day one, and then market seemed to rally a little bit. We did have a little bit of a rally a little bit after 10 o'clock Chicago time today, but then that kind of puttered off. But just overall, we have not seen a lot of movement today. This week we have, but overall, today we have definitely not seen a ton of movement per se in anything major. Apple's below its all-time highs again. So with that, we'll see if those we're short the 180 covered calls on those that expire tomorrow, and we'll see where those can go. But other than that, really not a lot of action today. Oil continues to stay above the 60 level, but that's pretty much it from my standpoint as to what's lighting up the tape over here at RCM.
So it's been kind of what you just call an underwhelming week in the market as a whole. So not I think. So one of the things I'm looking at with stocks. So the old all-time high SPX is almost 2,900, 28 something, 875 or something like that. We're like 125 points below that. And right now, we're also in this period where between earnings, right, where we're coming into mid-March. You've got spring break is coming up, or winter break, depending on living in Maine. It sure doesn't feel like spring break. But you don't have a lot of catalysts. Gary Kahn is gone, replaced, I guess, by Larry Kudlow, which is kind of funny. I think he had a little bit of a checkered past when he was at Bear Stearns, but probably everybody that traded in the 80s and 90s had a checkered past from where they were. So we don't have a lot of catalyst, right? So what's the good news? What's going to drive us higher without more earnings? I mean, how about the jobs numbers? If you look at the jobs numbers from last week, all that stuff came out right after the Thursday show. Do you feel like those jobs numbers were what I would say positive, kind of a positive, almost Goldilocks feeling to them, Mike?
It sure looked like it on Friday when they actually happened, with the way with which the market did react on Friday to them. I would say no doubt about it. But with that being said, I think that it seems like it kind of has tapered off a little bit in terms of what has happened this week. We're kind of right back to where we started going into the Friday jobs report. And it'll be interesting to see how the market reacts tomorrow, and that we've kind of tapered down slowly throughout the week. And I don't know if there was necessarily anything bad that happened. I don't know if there was necessarily a catalyst to drive us down. Not that we're down that far. I believe that from peak to trough, we're probably only down about like 50 points in the S&P. But it'll be interesting to see now that we're getting closer to where the numbers were before we went into the jobs report, how things are going to react tomorrow.
Right, because we've had great jobs. So the fact that it's still happening, the economy is growing and all that kind of stuff, those are, I think overall, those are long-term positive. It makes me still, kind of like the market, although I liked it a lot better when it was a lot lower. But just that being said, I do have a little birdie just asking about some of your cheapy calls. Have you been doing stuff? Have you been trading? I heard that you might be doing something with silver last week. Did you get to do any stuff relative with that?
Not with silver, but I did do some stuff this week. But you're gonna have to tell your little birdie that I'm gonna wait till the strategy block to talk about that one.
Oh,
This is going to be some strategy block, extraordinarily some great stuff today, but I'm reserving all this for the strategy block because I have an elongated strategy block that I am excited about today.
So is this one just like for the ages, like some of those other past strategy blocks where the people keep downloading and downloading and downloading and telling their children about how great the Tosaw strategy block is going to be?
I'll put in... So let's see, we've done like 600 episodes of this show. So that means I've done probably 400 strategy blocks. Holy cow, I never even thought of that. So I'll say of the 400 strategy blocks, this one will probably even make top 100. I'll give it that for sure. And then in terms of how high, we'll let the audience decide on that one. But this one will be top 100, no doubt.
Okay, but before we go to the odd block, because we're going to have kind of like a little truncated odd block today. Just because the action we saw was kind of good, so I wanted to dig into it with you a little bit. But there is something I'm going to call like the Dorsey pair, Twitter and Square. Has anybody actually looked at the relative performance of these two in the month of February versus the S&P 500? So, a year and a half ago even, Dorsey and Square was kind of on the rocks, and then it got a little bit of a lift, and Twitter was, down in the 14s, and everybody's like, it stinks. It's just their property is awful, even though they're everywhere. They just can't make any money. And all of a sudden now, Twitter, which, it's a stock that I like, that I have traded kind of what I would have a modified, I guess, a strategy block session on of just kind of rolling puts when it was not doing very well. But rolling puts saved my bacon in the particular one. It was kind of a joke around here because all it did was go down. But now both Twitter and Square are like leading the market this year, doing very, very well. And they're both kind of run by the same guy. So I'm just wondering, Mike, if you have anything on this Twitter Square thing. Is it something in the, in the Dark Knight Fund? Are there stocks that you like? Or are they just a little bit too, specky internet related properties that you're not quite ready for yet?
The Dark Knight Fund. My compliance people are cursing you as they listen to this show, but the Strategic Night.
Strategic Night. Oh gosh.
Got it. Well, I guess that's keep in mind it's Longo that makes fun of the Tropic of Capricorn Fund, not me. So remember, you and I need to unite and remember our true enemy here, and that is Longo with our umbrage. So, but no, I mean Twitter. I noticed Twitter yesterday. I had a client that had a combo on to where he was shorting the 32.30 put spread for April, and it was long the 35.36 call spread. And so he got out of that, made a little bit of money on it. So he called me and we talked about that a little bit. But definitely noticed Twitter. I mean, that's something that's hard to not notice. And in terms of the use that Twitter has, I mean, the fact that the leader of the free world primarily uses Twitter, that can't be a bad thing for the company by any means. So I think that Twitter over the long haul, at some stage when they figure out how to monetize things a little bit better, I don't see how it can't do well if they just get over this minor hurdle of making money. Now, I know I kind of say that tongue in cheek, but the reality of it is that you could have had this conversation about Amazon 20 years ago. I remember we had a debate I think it was in my junior year in college, in one of my business classes, I forget what it was, of will Amazon be able to survive because they never make any money? And some people were for it, some people were against it, but that was just something that Amazon just could never do for many years, was make money, but they kept building a wider and wider and wider base of things, and now Bezos is, I think, the richest guy in the world again.
Can you imagine that? I remember back in the day, the trade that people liked was in the, I guess I'm going to call it 2003 or something. I'm dating myself a little bit, but a paired trade, being long eBay because they made money and short Amazon because they didn't, and it worked for a really long time. It's hard to believe that Amazon was probably an $8 stock at one point after it had all those multiple splits. And talk about buying value. You could have bought, I think, Microsoft, Amazon, eBay, and Yahoo for less than $30 for all four names in 2002 at the bottom of the dot-com crash. I think the QQQs were, I actually don't even think I know, the low on those were 18 or 19 bucks. 18 or 19 bucks, and now they're 171 bucks. So, it's 15 years later, but finding value as far as being an equity investor, that's kind of one of your jobs. So you want to look for value. Look for properties that are still viable, but just the market doesn't like. And that's one way to scoop something. So with that, anyway, I just thought Twitter, that was kind of came to mind to me. And now that, I don't have to take as much heat on it as I did before, it struck me on the strength of those two properties through all of this tumult, basically. And I mean,
sweet revenge
every once in a while. But with that, I think we can wrap up the trading block. I think we covered, just about everything. And another thing that was kind of cool that happened today that Mike and I are going to talk about, but we're going to do that in the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Well, hello, everybody. Welcome to, it is kind of one of my favorite parts of the show. It is time for the Odd Block, where we dig under, get our fingernails dirty, look at some of the activity that was lighting up the screen, coming to our attention today. And I think really the story today is from an activity point of view is the MLPs, like the Alerian MLP, AMLP. Also, I want to look at KMI. What was going on in those? Now, on a day when the market was, I would say, mostly unchanged, kind of just flipping back and forth, AMLP was down 52 cents. At one point, it was down almost $1, which is a 10% move on a pretty slow day for what I would say is just kind of a high dividend paying stock. We saw a tremendous flurry of activity in the March 10 put in AMLP, where people were coming in, or paper was coming in and just buying the March 10 puts like crazy. So we had on a day of, let's say, on a flat day, AMLP, which is the Alerian MLP, it's a collection of KMI and all that kind of stuff. All of those, like Enterprise, Kinder Morgan, all of the like the pipeline producers that generate, basically they just pay dividends and they have some kind of rinky-dink tax treatment that allows them to do that. But the March 10 puts today in AMLP, over 10,000 traded on open interest of 176, and the prices ranged from pretty much everywhere, from as little as 25 cents to as much as 90 cents today, when the stock just had a massive range. The news I thought I was seeing was that there was a change in the tax treatment for MLPs, and that just sent them all cratering, although they did bounce off of their lows. So kind of going on the opportunity idea, where I have to really assess what the tax law is going to do to them going forward. It did generate a lot of volume, at least in AMLP. Do you have any thoughts about that, Mike? Or, was it you guys? Was it was it you guys coming in and just banging out the 10 level puts in that underlying? Because that was basically all the paper was just in that strike.
Yeah, I looked at that. Someone really thinks some bad things are going to happen tomorrow with that, or either they're really scared about a lot of bad things happening to a lot of people with that. But no, what brought that to my attention today is I got a buddy of mine. He's a financial advisor as well. He's by no means an option guy. He's a nice guy. He's in my Bible study with me. And so he calls me up. He's like, what's going on with AMLP? Is there anything that you're seeing that's really weird in this? I'm thinking, okay, this is something that he never typically calls me on anything like this. But so I looked at it. I just said to him, like, you know what? I'm looking through all the option chains, and that's the only real huge activity that I'm seeing, is that someone really thinks that either he may have just bought these at a low price today. I didn't go to look to see what the tape was and what the prices were, but I saw the volume on it. Or he thinks that something really bad's going to happen tomorrow or overnight, because there's a lot of paper on these things as to what's happening. So, the fact that people from the outside of the option world are calling, asking about that, that's kind of crazy. So yeah, that's how I heard about that one today. I don't have anybody in it, but definitely interesting to say the least.
Yeah, it's a sector that has not done very well. Remember, this was pre-oil crash, but all these names had huge dividends, and the stock prices were much higher. I think this product was like a $25 product or something like that at one point, much higher than it is now. So, yeah, and the thing is, I think a lot of these puts are still open. I'm not quite sure what's happening with them at this point. Maybe people read the news and then the algos come in and kill it. But on the flip side of this, as a trade for unusual activity today, I was looking at the other MLPs, like the big ones, like Kinder Morgan came to mind. Probably a very well-run company overall. Founder has a big chunk of it. He's not a poor guy. So I was looking to see if there was definitely a lot of volume all over, but a trade did stick out a little bit that it looks like I can see. So somebody went to June, and I'm not going to say at the bottom, but, pretty close to the bottom. They bought the June 17 calls for 44 cents, and they sold the June 14 puts for 20 cents. So they're paying 24 cents for that combo, or let's call it a risk reversal. I found that kind of interesting, actually. So an interesting trade, at least. It's possible that they closed a position, because I also saw 4,600 of the April 18 calls trade over the April 14 calls. I'm sorry, over the April 14 puts. So that it get a sense that somebody might have been just closing that particular position out, or loading up a little bit more on either of those. So it's one of those where I think they're taking the fact that there's a bit of an opportunity and loading up. So there was enough open interest in April to lead me to believe that it was a close, because there's over 5,000 contracts in both strikes. And the June position, there was almost no open interest in the 14 puts. So the June feels more opening. So my thought is they're probably trying to just close the April, give things more time, and then roll into the June. But it's still, it's a debit risk reversal, and they want to get long. So this is one of those where KMI has not done very much this year. Even with oil going straight up, the underlying is well off its highs. And, the highs even in the last 3 months was somewhere near $20. So for a stock like this to kind of perform like that, it's odd. As a matter of fact, it's at mostly, it's right around a 2-year low. So if there is any, let's just call it a daylight for this industry, you could scoop the industry at, I would say it's not the total dead lows of a couple of years ago when oil was $40 a barrel, but it's not too far from that level right now. So I think it is an opportunity. It probably is going to take a little bit more investigation, because I want to see if there's really the tax law change is big enough. So I'm sure everybody's already cranking that out right now. But the price seems right for an industry that's not going away. Anyway, do you have any thoughts on KMI at all, Mike, or this risk reversal like trade, which I know you've been known to dabble in this type of trade before?
I do like to dabble in such things, but for this one, that is not me, not in that industry.
Right. It's a little too squirrely right now. Is that kind of what you're thinking? Like, I'm not really sure I want to sell puts in those things right now.
No, I don't think I'd want to sell puts in that. That is definitely on the squirrely side. I mean, there's a time to take a chance and do things like that, but that one's still a little bit, as you put it, squirrely.
It's a little squirrely and a little raw. Not quite. It's one of those where and usually I also too, when you first see something really fall apart, it's okay if you sit back and just look and see, what was the cause, and you evaluate. It takes some time. Because you can always sell out of the money puts at a lower level down the road. That's the good part about it. So it's not something that you have to do right away unless you're obsessed with trying to trade something and close it the same day. You have the luxury of waiting, because there's always those strikes that are a little farther out, and you can wait all you want. So with that, and by the way, there was a little bit of, I think we were being hazed a little bit, Tosaw, on the way that we ganged up on Longo in the intro to the show.
Well, that's what he gets.
Somebody took umbrage for him. He'll be happy to know there's at least one person out there that is doing that.
That's nice. That person must be like a mean boss at their company or something to defend such activity.
And well, I guess with that, with giving Longo a little shout out, we will close the odd block with some strange, with the strange activity that we saw in those MLPs, and we will move into what everybody has been waiting for. So I've heard we will move into Mr. Tosaw's strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
Well, now, again, it's a time where I don't have to really say anything. I just let the phantom wisdom that is Mr. Tosaw with his years of helping clients invest, being on an option desk, learning all this option stuff, and basically strategizing and doing stuff where he actually will sit down and he's going to tell us, I might ask him a question or two, but he's going to tell us about a current strategy he's doing, why he likes it. And with that, I'm just going to say it's all yours, Mike. You go.
Excellent. Well, today it's 2-for-1 day on the strategy block. I have an extended strategy block today because based on a question, based on the odd block that we had on Monday, there was someone that was selling puts for a nickel out of the money. And, it's one thing to where the concept with selling a put to get paid to get into a stock, that's a great thing, but there's a point to where you're better off just putting in a limit order, I think, and that's what I want to talk about today. So that's the first part of what I want to talk about today. So when does it make sense to sell a put to get into a stock, and when does it make sense to just simply put in a limit order? So let's take a look at XYZ stock, my all-time favorite stock, because it always does exactly what I want it to do. And let's say it's trading at $50 per share. I'm sorry, $55 per share. And you would love to own it for, say, $50 a share. So what you could do is you could sell the 50 put, and if the stock were to go down to the 50 level, you get paid to buy the stock because you're obligated to buy it at 50, but you're happy to buy it at 50 anyway, so why not get paid to buy it? That's a wonderful thing. So with that in mind, you sell the 50 put, and if it does go down there, you get it put to you, and life is good and everybody wins. But let's say it does not go down there, then you don't get it put to you, then you still get paid for waiting. So it's not a bad deal if that's what you're looking to do for selling a put. We've talked about this strategy at least 6 trillion times on this show, and I think in every option trading discussion on earth, they talk about the joy of selling puts. But when is it not a good idea? What are some things with which you need to look at? What's the downside of doing that? Before I get into what price makes the most sense to do that, I want to get into the disadvantage of doing that. So let's say that XYZ stock's at 55 and you're short the 50 put, and the stock goes down to $49 per share. And you're thinking, great, I'm going to get into this stock. I wanted to get into it. This is a wonderful thing. Yeah, I know I'm losing money on the short put right now, but we still have 3 weeks till expiration. And as long as the stock stays around this level, I'm in great shape. I'm getting paid to get into this stock. Isn't life wonderful? Well, here's when life is not so wonderful when doing that. The stock, then after it goes down to 49, goes up to 62.50 within a couple days. And you're thinking, I'm short that put, and I made $2 selling that put because the stock's gone up so much. But man, if I had just owned that stock, I could have gotten a $12.50 gain on that if I'd have just bought it at 50. That's one of the disadvantages of selling a put to get into the stock. Yes, you get paid to get into the stock, but you also are giving up the time frame of when you get into the stock. You're getting paid for that uncertainty. You're not certain of when you're going to get into that stock, but you get paid. You get guaranteed pay, and the guarantee is the premium you collect on the put. You get guaranteed pay for taking on that obligation for the person on the other side of the trade, the option buyer, to dictate when that transaction actually happens. So in terms of just selling a put at whatever price to get into a stock, that is the number one disadvantage of doing it that way, as opposed to just simply putting out a limit order. Because let's say, same scenario, you just put in a limit order to buy the stock at $50 a share. Stock goes down to 50, you buy it at 50, it goes up to 62.5. Well, then you get to be a part of that. So by comparison, that is a situation to where it's a disadvantage of selling a put to actually get into a stock. Now, with that being said, The other things to consider on that are what price should you use to actually get into a stock? What's a good value to get into it? And to start, I would say that it's never really good to use a nickel no matter what price the stock is. And here's why. The reason why is that you're giving up that uncertainty that I just described. You're giving up the potential benefit of the stock going from 50 to 62 or whatever, and you're giving it up for only a nickel. That's not worth it. If you don't think the stock's going to go up more than a nickel once you get into it, then you really shouldn't be messing with the stock to begin with. So that's kind of one thing that I'd like to mention on that. So what is a good price to actually use to sell a put to get into a stock? Well, I like to get roughly a 1% monthly return or about between a 10 and 12% annualized return. Now, here's the way to think about that. Let's say that the stock is the stock's above where you believe you would like to buy it. Well, if that's the case, then by buying the stock at a lower rate, then you need to make it worth your while to give into that uncertainty of the fact that you might not get the stock on the exact terms that you're hoping for. And with that being said, I want to get something to where it's going to be at least similar to the average of the 100-year bull market that we're in stocks, and that's around the 10% annualized mark. So that's kind of my general rule for it. And I usually prefer to have it a little bit higher than that, because let's say I were to sell the put for $1, I like to get out of it for 20 cents. We've talked about on the show before, my rule of when I sell an option and then I want to get out of it to buy it to close, I like to get about 80% of the potential profit and then I'm out. Because that last 20%, it's like when you get a towel soaking wet, you can squeeze the water out of that towel, but you can keep squeezing and squeezing. You're not going to make that thing totally dry. You're going to do things to make it a little bit more dry, but you're not going to get all the water out just by squeezing it. Trust me, I've tried. And when doing so, trying to get those last few pennies out of an option, it's a similar effect. It's hard to get them. So I like to just take 80% of the premium and move on with life. Now, with that being said, I think that, and then if you want to get put in the stock, then you just kind of sit there till expiration and then you own the stock. So that's kind of what my general rules are when selling a put to get into a stock. And if it's like a 2-week option that I'm using, then I don't necessarily need 1%, maybe a 0.5%, just whatever comes out to about 10 to 12% annualized is what I'm looking for. Now, moving onward, let's go into part 2 of the strategy block. Part 2 is what I've been doing lately. Now, we've talked about what I did a few weeks ago when we had the crazy market turmoil of all those spreads that I legged into and got into for pennies pretty much because of the crazy volatility days. Where are we at right now with all those? Well, I've done a bunch of stuff, and some stuff's been profitable, some stuff's been at a loss, but for the most part, February's been kind of a break-even month for me, with the exception, February and early March, with the exception of those spreads that I got into for a lower level. So with everything that I'm doing right now, where we are at is if you were to go back to January 31st, that was the end of January, it was after the all-time highs were put in on January 26th. If you were to go to that and take the positions that I'm in now, and I'm actually short a put spread and I'm long 2 out-of-the-money calls, which I'll explain in a second, and if the put spread were to expire worthless and the out-of-the-money calls were to expire worthless, then we would be ahead 3 pennies between February and April expiration. So I'm basically trading on kind of the mark. For lack of a better term, I'm trading on house money right now. And normally it's not my typical MO, but in terms of just the way with which I got into all these options, but I'm a big believer in you take what the market gives you, and this is what the market gave me. So the other day, I believe it was Monday. I forget if it was Monday or Tuesday, actually. We had a down day. And what I did was, going into the day, I was just long a double position in the 285, 289 call spread on SPY expiring in April. And the cost basis for both of those spreads was roughly 6.5 cents per spread based on everything that I've done in February. And this is starting from January 31st, basically. So I'm kind of just sitting on them, waiting for the market to do something. And so when the market went down, I bought to close the 289 calls for, I believe it was 33 cents, I believe, each. And similar, I forget the order in which I did all this, but I also sold in April 270, 265 put spread for, I believe it was 81 or 82 cents. It was in the low 80s. And so by doing that, what I did was I shifted risk, meaning that I now have greater downside risk, but I do have more gamma to the upside right now. And my thought process behind it was, would I be comfortable selling the 270, 265 put spread right now? And the answer is yes. And if I combine that with all this out of the money stuff that I got for free, pretty much, I'm comfortable being in that position, because if the market does increase, you're going to have one happy uncle right here. But if the market decreases, the out of the money calls, I'm kind of just letting ride at this point because they cost such a small amount of money. And I'm just going to kind of manage the risk on the put spread like I normally would. So with everything that's going on with what I'm doing right now, the way I look at it is that if the market stays the same, well, okay, we had kind of a break-even couple of months. Not ideal, but it's a lot better than losing. If the market goes down, well, I'm comfortable managing the risk on the 270, 265 put spread. I can roll it down, roll it out, or do any of the other techniques that we've talked about on this show a bunch. But what if we do go back to those all-time highs? What if for some reason we do go up to the 286 level in SPY, we go to the 290 level maybe? If that's the case, then all of a sudden I and my clients that are in this trade, we're going to realize the true power of gamma, and we're going to realize it in a major way. The enemy of gamma is theta. And so with that put spread in place, that kind of takes on the theta to neutralize the risk of gamma, or I guess it finances the cost of the gamma. And then the risk management skills that I have hopefully will help in case the market goes down or that put spread. So in terms of what I've been doing lately with SPY, I built up a lot of cheap gamma in February, and just buying the calls straight out, it would have been anything but cheap. But the fact that we were able to do the spreads like we were able to, as I talked about on the past shows, we got a lot of really cheap gamma. And the gamma might go out worthless, but it was really cheap to begin with. But if for some reason we go back to where we were about a month and a half ago in the markets, once again, it's going to be very happy times for Uncle Mike in April. So that's what I've been doing lately. That is how we get into the kind of have our discernment between limit orders versus short puts getting into stocks. And that is the two-part strategy block for today.
Holy gosh. That is a strategy block for the ages. I have to say that's one of your top 10. That was a great one. I liked it.
I don't know if it'll ever top my 12 days of Christmas risk management a few years ago, but thanks for the compliment nonetheless.
Right, it was good. And I like the same 1% put rule for selling puts, just making sure that they're going to pay you something for that risk, because if nothing happens, you might as well do at least as good as the market does. And also the clever use of short put spreads to try to finance those upside calls and maybe really generate those extra returns that, make yourself and clients happy. So very excellent strategy block, Mike. And with that, maybe we should take some viewer mail. Are you in that mood? I guess we should close out the strategy block and see what the people have to say to us.
Let them speak.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
And everybody, welcome to the Mail Block. This is your chance to speak. Speak to Mike, speak to me, and speak to Mr. Longo, although he is not here. But since I'm here, I get to pick the mail I want to read. So this is actually a little exciting for me. And since it is me, I'm gonna pick a piece of mail about myself because, you know, what the heck? I'm here and I'm hosting the show, so that's what I'm gonna do. Question from Matt M. Why does Mark always say that Andrew doesn't understand expiration of vertical spreads and SPX? Is that true or some inside joke I missed? Well, the answer to that question is, Matt, there was a time when Mark was reading a viewer mail, and I had at the exact same time I had gotten a text from the Greasy Meatball where I was trying to pay attention to the meatball and Mark, and all of a sudden the whole question he asked me about a call spread, which at the time was just what is a call spread worth, and you know, how does it close, or how does it mark? I totally missed the question because I was trying to pay attention to a trade Mark and I were talking about. So I missed Longo's question, and it made me sound like I knew nothing about an SPX call spread. But it's always been a good joke for the shows because I couldn't answer literally the simplest question in the world. So I think that is the answer to that piece of mail. Tosaw, can you mute? The next question is from Jello Fan. VXX 1 year 50% out of the money puts plus VIX 3 months 15% out of the money call verticals 5 or 10 handles wide. Is that the secret sauce? From Jello Fan. An interesting question. So what I would say is a couple things. One is part of the problem with a 3-month call spread is you have to, in VIX, you've got to really work out what that call spread is going to pay you on what I would say is sort of a normal move for VIX. So, you know, if you're trying to pay for your 50% out of the money put, you have to make that call spread is really going to generate anything. So one of the easiest things you could do is say, okay, you know, we were just trading VIX 12, the whole market blew up, but how did those call spreads perform during that time? So I think a 5-handle call spread might not be enough. You would have to do 10 handles to really make it pay. But as far as a concept goes, you know, you buy those 1-year puts and then you buy some VIX call spreads. I think that actually could work out. You just have to make sure that you sell your VIX call spreads when they come for them. I would say that would be the only thing. One of my favorite trades is when VIX call spreads gets cheap, and then you could buy short vol deltas against them instead of just, you know, all the time just being long VXX puts, and then sometimes you get run over, sometimes you don't. If you have a little bit of some VIX call spreads in your arsenal, that could work. So generally with VIX, you need very wide spreads in order for them to perform. They do not perform super great when you have a tight spread. A 3-month spread for 5 handles might not yield you very much. Literally like, you know, 30 cents or 40 cents or something like that, because don't forget the backwardation or how the VIX futures move is 3 months out, you're not going to get a ton of movement in that future. It will move, but it won't be a ton relative to everything short term. So you have to keep in mind, you know, what that movement is. Usually a 3-month future is only going to move at about 30 delta to whatever the cash is. So you get a 10-point move in the future, you're going to get a 3-handle move in that VIX future. So, you know, if you go from 12 to 20 even, you're only going to get maybe a 2-point move. One of the best sources for that is you could go look at VIX Central and see how those futures move, and then you can estimate the delta on what kind of call spread you want to buy. So I like those long-term puts. They've worked pretty well. Probably a better time now to buy them than normal because the longer-term vol is coming down, but relative to the size of the move for VXX. I would say the only risk in that is if they screw with VXX like they did with SVXY and UVXY, that is a potential risk. So I would, that kind of changing the underlying price, I don't think it's going to happen, but the fact that that has happened, I would just keep that in mind because that would literally take your put premium and drive it to zero if they did do that. If they change VXX to, let's say, a half product or something like that, which, again, because it's a long vol product, it shouldn't be a problem, but there was a little bit of cover your behind from the issuers. And I would not be surprised if, somebody sues them over that. It mostly just, it also hurt the holders of those products, at least the SVXY holder. So just as an addition for that, just be mindful that if they do change the makeup of VXX to reduce the volatility, that will destroy the volatility in those long-term options. And it would be very hard for you to recover from that. So it's just it is a thought. I don't think they're going to do that with VXX because it works how it's supposed to, even though I call it perennially crappy. It does do what it's supposed to do, and people are kind of used to it on that score. So I don't think that will happen, but it is something to consider. But I do like your kind of your secret sauce recipe, but the key is you got to close your call spreads. And with VIX call spreads, you can't be greedy. If you're hitting some of those targets to pay for puts or something like that, just take it and wait, and then kind of reload at another time. So, and I think those two questions, I didn't even let Mike come in for a question, but he did such a great strategy block that I shut him out on these, but I had to defend myself on the SPX vertical now that somebody had to ask a question on that. But I did think this VIX one was very topical. So don't forget risk of long-term options. That Vega could be a problem. The Vega could be a problem if that happens. And with that, I think we'll close out the mail block and we will go in to see what the heck everybody is looking at in our Around the Block segment here at the end of the show.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And welcome everybody to Around Your Block, to your Around the Block. To Around the Block, this is the part of the show where we see what is on your radar screen for the rest of the week. And besides my dog jumping out of my office like a crazy person, Tosaw, what is on your radar for the end of the week?
I'm just watching the Dogs of the Dow. No, just kidding. Wanting to see, because we actually were right back to where we started before the employment numbers that came out last week, about give or take a few points, and curious to see how the S&P can react to this. If we're at a level of support, or if the market views this as a level of support and reason to come up again, or if the market chooses to continue to go lower and break through this. But it's appeared that thus far buyers have come in, but as everybody knows, a lot of things can happen. Tomorrow is expiration day, and also today was SPY ex-dividend day, so if you didn't close out short calls that are in the money, you might have some short shares of SPY in your account tomorrow that you weren't planning on. So if you can just take a look at that right now, you still might be able to do some late hour trading with the underlying if you can, but the options themselves, there's really nothing you can do about at this point. So just keep that in mind. If you see something weird tomorrow, that may be the reason for it. That is what I am watching at this point.
I as well. I like to see where our catalyst is for that, because before it almost seemed like there was that rush to get to 2,800 and rush to move higher and all that kind of stuff. And it seems like that rush to rally has kind of gone away a little bit. I don't think we're going to see it. I would like to see VIX touch and hold a new low. And that would get me maybe, a little bit more in the cautiously bullish camp. I feel like we're kind of a sideways market until some of those earnings come out again. I think that's really the big thing, like the tax loss coming around, and we'll see how earnings go. So I think there's a lot of potential upside catalyst. I think your April positions might not be a bad idea, Mike Tosaw. So as earnings come out and we roll into that, those are all things I'm looking at with bated breath. We have some Fed next week, but those are really the two big things. So we need a catalyst for up, and my guess would be another slew of good earnings would cause us to move up, and more trauma out of Washington, D.C. probably moves us down at this point. And with that, we will close out around the block. And Mr. Tosaw, what do you have? What do you have going? Anything good going on at RCM Capital this week, next week?
Lots of things good going on every day at RCM. We had our St. Charles Investing Club meeting on Tuesday night. Lots of people came. We're really excited about that. So for those of you that are in the St. Charles area, feel free to contact me about how you can get involved in that. It's totally free, and just a bunch of us come to my office and we just talk about trading. I don't know of anything that can possibly be more fun, quite frankly, for this audience than that. So with that being said, we have that. We have our next meeting scheduled in April. I believe it's on the 10th or the 11th. I have to look, but as we get closer to it, I'll have an exact date for it. But on there, that's what we have going on. And if you are looking for a financial advisor who is looking to take advantage of things that are happening in the market and manage risk properly and really believes in risk reward, give me a call, 312-212-3531, or shoot me an email at mtosaw@rcmfs.com.
And with that, also with me, I've got my Vol newsletter coming out. I will be in Silicon Valley speaking to a group in April, early April, for those that are interested in that. And the Vol newsletter is doing okay, coming over. For those that want to learn Vol, that want to actually learn it from afar and see how to manage Vol, the straight Vol product trades, and pair with index options, it is a great way to learn. Just pop over to optionpit.com and look for Vol newsletter. And with that, that is it. The show is done. I hope Longo's having a good time. Thank you, Mr. Tosaw. And with that, we will see you next time on The Option.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.